All right. Hey guys, I'm here with Morgan Smith, head of portfolio strategies at Horizon Investments. Morgan, thanks for joining me.
Thanks, Andrew. Always a pleasure to join you.
Yeah, I appreciate the time. Morgan is father to a new baby. How's that going?
It's going well. We got our first illness going through the house, so family is surviving. But it's good to kind of get put through the woodshed early, right? So we're learning things quick.
First and last. I doubt there'll be any more after that.
Yeah, we're good from here. So
Yeah,
we're immune.
Yeah. Well, Morgan, I just wanted to talk a little bit about, I think the topic on everybody's mind right now, at least what I'm hearing, is what's going to happen with this bank fallout we're hearing about with SVB. Is this something we should be concerned about? Do you see it spreading, or is this an isolated incident?
Yeah, we would lean more towards an isolated incident. We don't see this as being the same as like a 2008 type scenario. Silicon Valley Bank was essentially they weren't running a typical bank fashion. And what they did is they essentially had a poor mismanagement between their assets and liabilities, getting in the weeds of a way, saying that, they went under. They were also highly leveraged to that technology sector, which very clearly see the headlines. You see layoffs happening in that area. That is not good when your bank is leveraged to one industry in particular. We saw them go down as well as a couple others, Signature Bank as well. Again, these were banks that were doing a significant amount of their business with things in like the crypto industry, right? That is not necessarily indicative of your typical regional banks or banks that are more diversified across different sectors. So in our view, it is a little bit more isolated there. We saw some fallout earlier this week, which was more of just kind of a herd reaction of investors and depositors saying like, oh, what is going on here? I want to take my money out. When the FDIC already came in and kind of calmed things down, they're going to put regulations in place to make sure that depositors are made whole. So we think this is more of an isolated incident of mainly some banks that were not running things properly, but we don't think this is really a systemic issue that is similar to like a 2008 or anything like that.
Yeah, so far it seemed pretty isolated. It looks like there's pretty big bounce back today on most of those banks already. So
the risk really is that this herd mentality really pulls through, right? So there is risk there that everybody says, I want all my money out of this bank Z tomorrow, right? Whatever it is. And if all customers do that, then the bank's going to have issues and the FDIC will have to come in again. We don't see that as being a primary case what we expect going forward, though.
Yeah, well, thank you for that. It looks like too, we talked last time about inflation, where you guys thought it was going, and really we're hoping for a downward trend. Looks like that's what we're getting. I saw good inflation numbers coming in today. What's your thoughts on inflation going forward? And is this something we're going to continue to see inflation trending down?
Yeah. So inflation, certainly, if you go back to kind of the back half of 22 till today, things are moving in the right direction. I'd say the deceleration of inflation has slowed down a little bit in 2023, and that it's kind of flattening out a little bit. Our expectation is still that we're moving in the right direction. Those headline numbers are still higher than that historical 2% that we were shooting for. But goods inflation, if you look broadly at goods, that's back down to zero, or at least close to zero as of today. It's really around that services and wage growth. And, our expectation is by the end of the year, that wage growth number will go down, which will bring down kind of those headline numbers as well. So there's still some work to do, but things are certainly moving in the right direction, and we're kind of seeing that effect of higher interest rates as well. So, again, we think things are moving in the right direction. That's kind of what markets are anticipating at this point.
Crazy. At least we're not seeing the crazy numbers we were seeing at the end of Q3.
Yeah, exactly. And, we're not paying, whatever it was, $28 for a 2x4 anymore, right?
Yeah,
so things are
$50 sheets of OSB, right?
Yeah, exactly.
Well, I guess that kind of dovetails me into to my final question is, what is you guys, if you look at the news, things look grim, right? You still got the war in the Ukraine dragging on. You've still got inflation. You got things kind of brewing in China that don't look great. But what is the data telling you? I mean, as you look at, you know, debt and spending by, consumers, what is the data kind of telling you as far as where you guys think the market's headed in the next 9 months to a year?
Yeah, yeah. Generally speaking, we would be, I would say, rather optimistic compared to, maybe what you're seeing on TV. And that's just because, there are some headline numbers that you can grab that make things look bad. I think we've seen credit card debt getting brought up a ton. If we look broadly at credit card debt, like it's basically on trend to where we were pre-COVID. Like nobody used a credit card for 2 years because everyone was getting money from the government and also didn't have anything to do. So, basically it's credit card limits or credit card debt levels getting back to where they were previously. And people are making a lot more money than we were 3 years ago as well. You've seen wage inflation pick up. So you combine that as well as, very low unemployment too. That hasn't changed at all. And while things have kind of slowed down from an economic perspective, we still have a lot of these kind of headwinds in our face in regards to, inflation, the war in Ukraine and China. We also want to keep in mind, right, that from a long-term investor view, markets, have been down, over the past, call it year and 3 months. We've seen a pretty, a decent drawdown of north of 20% in markets. Typically, this is a time when markets begin to rebound, right? Things get a little bit cheaper overall from a stock market standpoint. And the stock market is going to react and bounce back prior to economic data improving, right? Stock market will always be a forward-looking mechanism. So there's a lot of noise on a day-to-day basis. In our view, as long as you can stay invested, we think long-term things are looking good. And by the end of the year, if you start to get trends and expectations that, that inflation is going to come down, that interest rates are going to stabilize, that can kind of gives room for profits and growth in the future. So, I'd say we're rather optimistic, I'd say, relative to the gloom and doom that we tend to get from a headline perspective.
No, there's certainly plenty of that. That's for sure.
Yeah. Yes, there is.
Yeah, separating the wheat from the chaff. It's hard to do these days.
It is, yeah.
Yeah. Morgan, I appreciate the time as always, and we'll do it again next quarter.
Awesome. Sounds good. Thanks a lot, Andrew.
Yeah, man. Thanks.
All right. See you later.
Investment advisory services offered through Prudeo Partners, LLC, an SEC-registered investment advisor. Prudeo Partners and Horizon Investments are separate entities. The content within this video is intended for educational use only and does not represent individualized legal, tax, or investment advice. Clients should consult with their legal and/or tax professionals for advice specific to their needs. This webinar does not represent an offer to buy, sell, replace, or exchange any product, service, investment, or account.